Okay, so the source material we dove into for this deep dive, it's based on some recent analysis by Jim Rickards, and honestly, the claims are pretty startling.
Yeah.
Urgent, even.
Really urgent. We're talking about warnings of a coming silver reset and these, well, huge price targets.
Huge is right, like
Uh,
$23,000 for gold, and silver potentially rocketing past $100 an ounce.
that's the forecast. It grabs your attention.
Definitely. So our mission today is really to unpack the thinking behind these, frankly, extreme numbers. Why is silver being called a lifeline asset?
Mm.
What are these supposed structural drivers making them unstoppable?
Well, I think the key is this distinction Rickards makes. It's central to the whole thing. Gold, he sees as pure money, a store of wealth.
Right.
But silver's got this interesting duality. It's precious, yes, but it's also a critical industrial input. Think electronics, solar panels, all that stuff.
Okay.
So to understand silver's potential explosion, we really need to look at the three big factors driving gold first, because gold kind of sets the stage.
Makes sense. So gold, it's already pushing, what, above $3,800 an ounce now?
Mhm.
If we buy the premise this is just the beginning, what are those key drivers?
Okay, first driver, central bank buying. This is big. Rickards points to 2010 as the real inflection year.
Before that, they were selling.
Generally, yes, institutions were often net sellers. But since 2010, countries like China, Russia, India, they've become consistent net buyers.
And they're not buying just to trade it.
No, exactly. They're buying for strategic monetary reasons, not short-term profit. And that, he argues, puts a sort of permanent high floor under the gold price.
A floor. Okay, I get the floor argument based on that buying, but still, $23,000 gold. That sounds almost hyperbolic. How does that floor lead to such a massive potential upside?
Well, that leads into what he calls the asymmetric trade. Because those central banks establish that reliable floor, your downside risk as an investor, it's pretty limited.
Right, you know roughly how low it might go.
But the upside, with all the systemic instability, fiat currency issues, the potential upside is basically unlimited, or at least vastly larger than the downside risk.
Okay, risk a little to potentially gain a lot. That makes sense structurally. What's the second factor then?
Straightforward supply and demand. Global mine output, it's been basically flat for about 6 years now, stuck around 4,000 metric tons a year.
Flat supply.
But demand keeps rising, both monetary demand and industrial demand. So flat supply, rising demand. Basic economics says the price has to go up.
Got it. And the third factor, this is the one people hear about a lot, gold, as the everything hedge. We all remember the 70s inflation.
Oh, yeah, a staggering 2,100% gain between 71 and 80. It definitely hedges inflation.
But the claim is it hedges deflation, too. How does that work?
Well, you just have to look back at history. Think about the Great Depression. The Dow Jones crashed, 82%?
Yeah.
Just wiped out.
Total collapse.
During that exact period, the price of gold actually rose 75%. And maybe even more telling, the single best performing stock on the entire New York Stock Exchange through that whole disaster, homestake mining, a gold miner.
Wow. Okay.
So yeah, it hedges financial catastrophe, whether it's driven by inflation or deflation. It's proven itself.
So gold protects wealth at that macro level.
Mm-hmm.
But the source material really hammered this distinction. When things really fall apart, like a system collapse, silver becomes the crucial practical tool. Why silver? It's been lagging gold.
Right, and that lag is partly because of its industrial side, its use in solar electronics. And if you have an industrial recession, that can create a short-term drag on silver.
Okay.
But Rickards' argument is that in a true monetary crisis, its role as money will totally swamp its industrial role. That's where this idea of the silver reset kicks in.
Explain that reset mechanism. How does it jump so dramatically?
It comes down to the gold to silver ratio. Historically, that ratio, when both were seen primarily as money, it was much, much tighter. Maybe 15 to 1, 20 to 1, somewhere in there.
And today it's way higher.
Exactly, much higher.
Mhm.
So the thinking is if gold does make a run towards, say, $20,000, for silver to just get back to a more historically normal monetary ratio relative to gold, well, that's how you suddenly get these $100 plus silver price targets. It becomes mathematically plausible based on a ratio correction.
And this is where it gets really practical for you, the listener. In a true collapse scenario, grid down, currency worthless, that 1 ounce gold coin, maybe worth $4,000, is just too big for buying bread or gas.
Precisely. It's impractical for everyday needs. That's why Rickards calls silver essential liquidity. A few silver ounces, with maybe $40 or $50 each today, become your actual walking around money.
For food, fuel, basic bartering.
Exactly, basic necessities. And that's why the recommendation is so specific about physical silver, even down to owning a monster box that's 500 one-ounce American silver eagles, specifically for that liquidity purpose.
So, doiling it down, the core message seems clear. Gold is the ultimate insurance to preserve large-scale wealth through disaster.
Right, preserves wealth.
And silver provides the essential day-to-day liquidity you'd need if the financial systems actually break down.
That's the distinction. Wealth preservation versus immediate transactional ability.
And just as a final thought here, Rickards brings up this interesting psychological point. Anchoring bias. We get stuck looking at today's price. But think about it as the base price of gold climbs higher, say it actually passes $10,000, then $20,000. Each next $1,000 jump feels psychologically smaller, right?
Huh.
It's a smaller percentage increase.
Yeah, the resistance fades.
Exactly. And that diminishing resistance could fuel a kind of frenzy stage where the final run-up to that $23,000 forecast happens much, much faster than people expect, almost like warp speed at the end. So what that final acceleration actually looks like, well, that's something for you to think about.